Okay, we now are in chapter 16, our final lecture. Of course, I will review the problems after the problems have been turned in, but this is the final chapter lecture, and I hope that the course has gone smoothly for everybody. And this chapter actually looks at franchising and different ways to evaluate franchising options. So if we were to look at franchises, there's 4 common fees. The first one is an initial fee, and that's usually paid at time period 0. So if you wanted to buy a franchise, you'd have to go ahead and pay for the franchise, and that's the initial fee. It can be based on a dollar per room if we're looking at a hotel, but for the most part, it's going to be a dollar amount paid today. Then we have a royalty fee, and that's something that a franchisee needs to pay the franchise for their name. And then we have a reservation fee, which of course you're not going to have in a restaurant operation, but you're going to have in a hotel operation. And it could be anything. It could be that you're paying $5 per reservation, or it could be a percentage of room revenue. And then finally we have a marketing fee, and that's all of these percentages are on a percentage of sales. So, or a percentage of room revenue. So we need to know sales to calculate our fees. So the way that we're going to go ahead and evaluate a franchise is the first thing we're going to do is we're going to take that initial fee, which is paid once, and again it's paid in time period 0. And then we're going to go ahead and combine our annual fees that are paid as a percentage, because there's no reason for us to do multiple calculations. And we're going to subtract those fees from our revenue, or our projected revenue. And of course, our goal is to choose the franchise option that gives us the highest present value of income. So the example I have is Black Bear Burritos, and let's assume that we want to buy into the Black Bear franchise. We're going to have to pay $30,000 today to get in, and then we're going to have royalty fees of 3% of sales and marketing fees of 7% of sales. And for this example, because the math is really easy, we're going to assume that we project $1 million a year in sales, and we're going to calculate the present value of our expenses. Okay. So if we look at the math, of course, our expenses are negative, so we're going to go ahead and keep everything in negative. We have our years 1 through 5, with time period 0 being today. Then we have our cash flow, and then we have our present value calculation to discount it, and then our present value amounts. So our first year we have $30,000, and $30,000 today is $30,000. In year 1, we have the $1 million times 10%. The 10% was the 7% and the 3% from our 2 fees added together, and we have to pay $100,000 a year in fees. We discount that at 0.8929, and we get $89,290. In year 2, because we have not projected, this is a simplified example, of course, and we have not projected increase in sales. Our fees again are $100,000, and we discount that for 2 years, and we get $79,720. We're going to do that for years 3 through 5, and the present value of our franchise expenses are $390,000, $390,490. So for $5 million of sales, we're paying almost $400,000 in expenses just to the franchisor. Now in reality, of course, we're going to have other expenses. So we need to go ahead and include as many variations to the cash flow of revenue and expenses in our equation. So what we're going to do is we're actually going to go ahead and take a look at other relevant income statement type costs. And those are labor, fixed and variable, as you've seen in other classes, supplies, food and beverage costs, other variable costs, fixed costs, income taxes. So these are some, not all, of relevant costs, but if we were to do a consolidated projection, we'd want to include at least labor and food costs and fixed costs and taxes in evaluating our franchises. So what we would do, or what you're going to need to do on the test, is you're actually going to have franchise A and franchise B. They're going to have different revenue projections. Possibly they're going to have different expense projections, and it's your job to determine which one's going to be most beneficial for you. Okay, so that being said, let's put some assumptions down. Let's assume that we know that the Black Bear Burrito, of course we're going to use the same example as before with the initial franchise fee and the royalty and marketing fees, but we also have labor costs of 25%, supplies of 3%, food costs of 28%, other costs of 5%, then we have fixed costs and income taxes. The only one of these percentages that you cannot add together in your calculations is income taxes, and we have to go ahead and calculate our taxes after we go ahead and look at all of our other expenses. So now what I did is I actually did this on Excel because it's so much easier. Is I took those 5 years of projected sales, which you have $1 million from years 1 through 5. If you look in year 0, we have our $30,000 franchise fee, so the present value of that when we extend it to the right is $30,000. In year 1, we have the $1 million, and we went ahead and added up the 10% for our royalty and marketing fees, and I'm going to go back a slide, and our labor costs, our supplies, our food costs, and our other costs. So if we add those up, we should come up with 71%. 71% of our sales is going to those variable costs, and then we had fixed costs of $200,000. So we have an income of $90,000 before taxes. We multiply that 90,000 by 0.25, and we get 22,500, and that gives us a net income of 67,500 for all 5 years. The next thing we need to do is we need to discount those years. So if you look, we've got PV for 1 year, 2 years, 3 years, 4 years, and 5 years. That's at 0.8929 through 0.5674. So if you went to page 201 and you looked at the PV table for a single cash flow, for year 1 you would get 0.8929. For year 3 you get 0.7119, and again for year 5 you get 0.5674. We do the math, and then we add up all of our or we subtract out our initial fee from our net income, and the present value of this lease option is $213,330.75. That's the present value of our earnings if we choose this lease. So we want that number higher. So if we had 2 options and one had 200,000, we would choose this one because the present value is at a higher rate. Please do not hesitate to email me or call me if you have any questions on this concept. Thanks.